Hey everyone, it's Hunter Satterfield here at CWA. I'm one of the partners here and a member of our investment committee. As always, today I am joined by Brad Sanders, the managing director of Tectonic Advisors, and also one of my fellow partners here at CWA, Brian Bortz, who is the head of our investment committee. And this is your May market update. For the month of May, domestic stocks were up right around 0.7%, represented by the S&P 500 index. Global stocks at 1.4%, domestic bonds at 0.3%, and global bonds at 0.7%. So guys, before I kick it over to you guys each with a question, it's interesting to sort of see those numbers because as we do each of these monthly updates along the way, really this year we've seen a little bit more volatility within these different numbers. And now we're seeing a month that is overall pretty good and pretty strong for our clients and their portfolios. Now, since our last recording, Brad, I want to come to you first. We've gotten some information, some numbers from the Fed on what a lot of our clients are kind of concerned about and questioning, which is sort of just this concept of inflation and what's coming. And I think those numbers were maybe a little bit different than a lot of us expected to see. And so, Brad, can you talk a little bit about what those numbers were, and then what the short-term impact was, and then maybe what that near-term impact is on the market in general?
Yeah, sure. What we saw were just some inflation prints that people look at the beginning of May that came in higher than expected. Interestingly, we've been telling the Kane Waters Investment Committee since about January that we were probably going to see some weird inflation prints. We were thinking June. They came a month earlier. The one thing COVID really screwed up, and the shutdown screwed up, is economic data. If you think about it, when you do something like shut down the U.S. economy, it affects everything, and everybody's scrambling, and then you don't really even think about the second and third and fourth order effects of what actually shutting down an economy does. And then when you reopen the economy, it kind of does the opposite. So now we're in this world where you get a lot of this weird data coming through, and it makes things maybe look inflationary that aren't. I think lumber prices is a good example of that. Where everybody's pointing at lumber and saying inflation. Well, is that inflation, or is that an output gap? Because everybody was shut down, the lumber mills were shut down too, and now everybody's bidding for whatever lumber's around, and now that goes into an inflation number. And the market got a little bit volatile when those inflation numbers came out. The Fed subsequently came out and basically reiterated their stance that they see us getting to 2% inflation, and they don't think it's going to go much higher than that. We can wait and see on that. Those aren't really scary numbers. Inflation's not something to run from. It's just something to pay close attention to, because we might need to do some things different in the future. But for now, those look like those numbers are kind of one-offs. We might get a few more of them throughout the summer, and then we think those will balance out as supply and demand come back into balance. We do expect any of those inflation numbers, though, to continue to provide some volatility to the markets that maybe wasn't there previously. It's probably a reason why international outperformed the U.S. for the first time, probably in 2020 for a month. If you get a lot of inflation, you could argue that that's going to weaken the dollar. So you'd want to sell dollars, buy euros, and invest in Europe or something, and make money both ways. And that's probably what's going on there. We think that'll cool off too. Inflation's something we're watching closely in the short term, but it's not something we need to be reacting to, at least for the next 12 to 18 months, as this economic data starts to balance itself out and supply and demand kind of get back into some semblance of order.
Yeah, no, that's great. And I think a lot of things that you said there, is we talked a little bit about this on our April monthly update, which is just, really sticking to sort of the concept of diversification, diversifying across a lot of different sectors and, different asset classes from that perspective to help sort of, mitigate some of the sort of inflationary responses that the market may have. So that's very, very helpful. So, Brian, to come over to you, one of the stats that you and I were sort of throwing around this week was the stat that, since the onset of COVID, there is approximately $2.1 trillion of excess savings in American households, 2.1 trillion, which is, from a lot of the stimulus that's come into the economy from the government. But what's happening is we're getting a lot of questions from clients on, okay, I have this money, when should I invest it? What's going to happen with taxes? What's going to happen with inflation and interest rates? And should I wait? Should I dollar cost average this? Should I wait till after the new law is passed for taxes or whatever else? Can you talk a little bit about what your response is to a client when they ask those questions as far as timing of investments and that type of thing?
Sure. Yeah. Thanks for having me, Hunter. The programs that were passed through the CARES Act and subsequent acts as well, when you think about how much liquidity was injected into the economy through PPP, HHS, unemployment, stimulus, the list goes on and on and on. There was a lot of free cash flow that was available, and we get those questions a lot from our clients saying, what should I do with this excess cash now that my business has been restored and things are looking good? And from our perspective, we believe that there's a lot of pent-up demand that is out there, that consumer discretionary spending will probably drive our economy here throughout the summer. The old cliche of sell in May and go away doesn't necessarily hold true this year, because there's a lot of people that are ready to get back out there and travel and go to a movie and go to dinner and enjoy themselves again. The thing that I'm telling our clients is, your financial plan is a very long-term plan, meaning you're going to have a financial plan across multiple presidential administrations. The life of your plan is going to be for decades, and we're not interested necessarily in overreacting to any one swing of the pendulum or the other. So, we're telling our clients to be patient, to look at what's going to come out. And as long as they are sticking to their plan and being systematic, and maybe setting aside some of those excess after-tax dollars that they have, everything's going to be fine for them.
Yeah, that's great. Thank you. And also the cliche here in Texas of April showers bring May flowers is also untrue this year as it continues to rain down here. So thank you, gentlemen. On this sunny day, we're able to get in front of clients, which is great. I'm sure it will rain later today and for the rest of the month. Clients, thank you. We will be back in front of you for our June monthly update at the end of the month. Thank you so much.